So I'm going to get started right away, and I'm going to ask the obvious question. We've got a lot of debt in the United States. Isn't inflation, a good and expedient way to reduce some of those debts? Bill.
Well, there's no question that a person who borrows money can repay it with dollars that are of lower value after a cycle of inflation. So classic formulation in inflation is that the holders of debt lose and the borrowers of money win. Since our government's borrowing huge amounts of money, arguably it's a way to pay off the debt. But I'm not a big fan of that for a number of reasons. The most important is it's not a one-time event where we've borrowed a lot of money and we stop borrowing money and start paying off at a fixed rate the outstanding debt while the dollar loses its value. Instead, as we know, we're running an enormous deficit, so we have to be continually borrowing money. And as the cycle moves into inflation, the markets will anticipate inflation and demand a much higher rate of interest on debt. And the alternative, obviously, is to disregard debt altogether and simply print money, which is an argument I hope we don't get into because it's complicated even to describe in the modern world what it is to print money, but take it as a matter of faith that the government can print money outright if it wishes. But under that scenario, you bring on the specter of hyperinflation, and I don't think any reasonable person would want to bring hyperinflation to the United States as an expedient way of paying off debt because its social ramifications are horrendous. So I don't think you can walk that middle path of bringing inflation in to reduce the value of the U.S. debt because you simply let the market anticipate that and raise the price of your future borrowing. No, maybe we get a fiscal solution.
Barbara?
Well, I'm thinking about it from the perspective of an ordinary, man or woman who's trying to put some money away, both sort of in a precautionary way for a rainy day and then perhaps for college for the kids or a house or to start a business. And I think there's a psychology of inflation that really makes people think, what's the point in saving? Why bother? Because you won't realize any real gains. And so sort of at the level of the ordinary man and woman, the threat of inflation, I think, does pose somewhat of a threat to the disposition to save and to want to try to save more in anticipation of future expenditures.
Carmen Reinhart, Marty Feldstein, amongst others, have suggested kind of the path of just outright inflation is not an attractive one, as you point out. It not only has unattractive externalities, but also might not actually even work to the extent that markets anticipate the inflationary wave. And they've suggested we adopt, or they've suggested it's likely we adopt something similar to what we had after the Second World War, which was kind of a series of controls with moderately higher inflation. And this has been referred to Carmen Reinhart and her, by Carmen Reinhart and her co-authors as financial repression. Is that more attractive than just high headline inflation, or does that get us to the same end of creating negative real rates of interest for savers?
Well, I think negative real rates of return for savers is not a catastrophic problem in and of itself, and I would defer a little bit to Barbara on this, but if you imagine a culture where people are a little anxious for the future and feel responsible for themselves and their families, and they save, and they get a slight negative return on their money, and if you run the models for 10 or 20 or 30 years, it works out all right. If you're saving your savings, the reality is retail savers have never been the biggest, best investors. So the culture of savings and thrift is still good. So, but that of course depends on that perfect scenario. We're going to manage just that little bit of inflation, and we're going to get a slightly negative real rate of return for savers, and it's unfair, in the broadest sense. It's unfair to make the working and middle classes pay a tax in the form of a negative real rate of return in order to be virtuous and save their money, but it's not I don't think it's a grossly corrupting effect on society. I don't think it leaves the saver a sucker, because I think they're still better off than the non-saver.
Even if they get a slightly negative rate.
Yeah, I mean, again, in the best of all possible worlds, Mr. and Mrs. Pangloss would be saving and getting a real rate of return, and that would be nice. But I don't think that's the essential fact. The problem is that you have these two unstable aspects, which is no government really knows how to engineer that perfect small amount of inflation that gives that Keynesian or Fisher money illusion. Everyone's happy because they have a nice interest rate, and businesses are happy because they're getting a nice rate of return. That's unstable, and you can slip into toxic levels of inflation easily. And then on the side of virtue, I think we don't know when the saver feels like they're being cheated. And because we don't know whether the psychology that applied in the 50s is going to apply to the American population in the year 2015. And they may be in the age of much different exchange of information. They may focus on a negative rate of return and be outraged and find a justification for not saving. So this concept of this ideal small amount of inflation, and even with my caveat that people will not be materially harmed by negative real rates of return, all other things being equal, I think that's trying to manage two very unpredictable, unstable things, human behavior and instinct, with fiscal and monetary management. The probability of success is, it's just rolling the dice, so I wouldn't buy it.
So picking up on this idea that this is maybe not manageable, as Bill's suggesting, and that if we go down this path, the actual inflation rate or real negative rate of interest will be higher than desirable. Who benefits? How does this shake out in society? Does this hit George Soros and the small guy in the street the same, or are there disparate outcomes?
Well, isn't it true, I'll ask both of you because you're experts, that classically inflation helps debtors and hurts savers? And I think that the other factor to keep in mind is that we have a huge, what I would not be afraid to call a savings crisis right now. Fully a quarter of American households are either not saving at all, or they're significantly under saving. They have like $1,000 or less in the bank. And I think along with the threat of inflation, we have to worry about just people, getting people into a savings habit of mind. And so I guess inflation really hurts the disposition to save, and particularly the little guy who's trying to save for retirement or trying to save for college education, or young people who are trying to climb out of debt and begin to save bit by bit, for marriage perhaps, or a home, or more education. So it's a tax, I think, on the middle class.
It's a tax. So on the middle class, so the little guy has, so the bottom quartile, he doesn't have any savings or has less than $1,000 of savings. So it's not maybe good for him from the value of his savings, but he's less severely impacted than the middle class is kind of in the crosshairs of inflation?
So. I think again, my impression in some of the work that we've done is that people who have no savings aren't particularly sensitive to interest rates. Mm-hmm. In fact, they're so insensitive to the rate of interest that they go to payday lenders, and pay usurious rates of interest just for a little bit of extra money. But I do think that people with assets who are trying to build wealth in the middle class are vulnerable. They think about the rate of return on their savings, and so it is a problem for middle class people for sure.
What about maybe Bill on the same question, or maybe and also who benefits? Who's the winner?
I think the winner is whoever is fleet of foot. So. I don't think it layers itself evenly by class so much as who's flexible. So we know that the billionaire whose billions are invested in plant and equipment that can't be repriced in an inflationary environment is going to see the value of his investment shrink relative to inflation, even if in nominal dollars it goes up. The billionaire whose money is completely liquid and who can hire man of speculative ability to manage his money will be just as rich at the end of the cycle as he was at the beginning, and arguably richer. And the very young who are unmarried, who can move to whatever job is paying a nice wage in an inflation-adjusted sense, will just change. But the person who is fixed in his place or job because he has family or he has a home, he can't move. So inflation is going to run through the society and do damage, and those who can't get out of the way are going to be damaged. Historically, when pensions were in the form of a company paying you a fixed amount every year, and savings were in the form of fixed bonds where you clip coupons, then the old suffered horribly from inflation because they had no savings. I'm not so sure it plays out quite that way when Social Security is inflation adjusted and the like. And then the other thing you would find in high inflation environments is highly unionized industries where the unions could press management to raise wages promptly with inflation. They tended to do okay. So, I think we'll see it play out in a different way. But generally, I'll go one step further. The people who are rooted are more virtuous. God loves them more, And I mean that only half joking, but the people who've taken responsibility to set themselves in place and try to do something are thereby unable to abandon their responsibilities and get out of the way. So I think it's disastrous to have a very high inflation environment in terms of the impact on society.
Can I ask just a very dumb question? Where do we currently stand with respect to inflation? I mean, for the man and woman on the street, what would you say to them about the threat right now? Are we looking down the road to, future hyperinflation or very high inflation, or are we on the cusp?
There's a lot of, obviously Ben Bernanke has his opinion, and I think a lot of participants in the financial markets have their own opinions. I think I think it would be hard, one, to get everybody to agree as to what inflation actually is today, given the way the statistics are compiled, and then two, it's a great unknown. If you look, I think historically, the periods when you move from moderate or low inflation to higher inflation tend to be relatively brief, surprising periods, and so that have to do with the rate at which money changes hands. And so I think even the most confident of, maybe accepting Bernanke, but the most confident of observers about the Fed's ability to control inflation would suggest there is some risk, which is, I think, why part of the reason why this discussion, has so much merit in this context is we certainly don't know as to whether or not this is going to happen. But I think you would have to suggest that it's not a diminishing possibility. I mean, Bill, you'd know better than I would.
Well, I love that you had to answer the question first, because your
I'm the moderator. I'm not supposed to answer anything.
But your strong views on this are well known, but I think everyone's familiar that stock markets crash suddenly and unpredictably, and yet people say, you knew that was coming, it was too high, but no one knows it's coming. It's an unstable equilibrium, and the catalyst is unknown. And I forget the author's name, so I'm going to do him injustice, but market crashes are like earthquakes. Everyone knows an earthquake might be overdue in the Tokyo area, for example, and it doesn't arrive. When it arrives, people will say, oh, we could have predicted that. It's been so many years since the great earthquake in 1923. It was bound to happen. And though they know everything about what causes earthquakes, they can't predict them. You can know what will cause a stock market crash, you can't predict it. I think inflation, like you say, Sean, is similarly unpredictable. So you put all the ingredients together and you say we should have inflation, but it hasn't arrived yet. It hasn't arrived. But when it arrives, it'll erupt, and everyone will say, we knew it. Of course, we've been, what fools we were, it was waiting all the time for us. So the experience, again, funnily enough, with earthquakes, you go back to Japan, which has very low inflation. It has deflation, arguably, very low interest rates. The government has ballooned its debt and has spent the money in ways that are not productive from a term of return on investment. Beautiful buildings and beautiful trains, and I mean, they build nice stuff in Japan, but it's not productive from a business standpoint, yet no inflation, and that's been going on 20 years. Yeah. So we don't really know when it would happen. So to say what's going to happen, I think prudent people are fearful of it, and rightly so, but I'm not sure it's next year's problem or even 5 years from now's problem.
let's go take a step back and look at things that have happened in the United States. So looking at what has happened over the last 40 years, we've seen a steady decline in the savings rate. There's been a brief uptick post-2008, but still far below where you'd want it to be. But since the early 70s, I think we declined from 10% down to almost zero, depending upon how you calculate it, prior to 2008. Is that a consequence of some cultural phenomenon or institutional phenomenon, or is that just a consequence of declining, real rates of interest and people just making a rational decision and saving less?
Well, I would, of course, try to make the case that it was a little bit of each. But particularly, both institutionally and culturally, we have seen a change since, let's say, maybe the early 1980s, when we still had double-digit savings rates, to the 2007, 2008, and even today. And I think partly my analysis would be partly that there was an institutional retreat from community banking, from the kinds of incentives for small savers, combined with the rise of some anti-thrift institutions for the lower people in the lower income distribution, credit cards, massive use of credit cards, and then the disposition to see your house is your main savings account, your piggy bank, and to then look at equity in your house rather than other kinds of savings instruments as your wealth. And then, we know what happened there. So I think it was a combination. And then finally, just a complete retreat from the idea that it's virtuous and a good thing to be thrifty in the broadest sense, that there's a kind of ethic of wise use and conservation of your resources and a kind of, wild consumerism that did take hold during that period of time. So I think it's a simple answer, but all of those things that are not narrowly having to do with monetary policy or, interest rates or inflation figured in what has happened over that period of time.
And we don't have the counterfactual. We don't know what would have happened had you had those cultural trends and high rates.
We don't know.
Do you have an opinion as to where you would lay the blame for the declining savings rate?
I agree with Barbara, and I think that's why this project is so interesting, because I think it's mostly social or cultural, a shift. But Sean, to the extent that I would say there's sort of mechanistic reasons behind it, I wouldn't look at low interest rates and savings accounts. I would instead look at the boom. We've had such a great economy and close to full levels of employment and so many ways to do well, even for, America's still a fairly mobile society. So I think it's not so much that you're a chump because you're not savings. I think it's a chump because you're not going to get rich. Why not go out and get another job, do something? Why bother saving? You're going to get rich if you take initiative, borrow more on your house, take initiative, go in business. And for 20-some years, it's been more right than not that people are doing well. And so I think
just being entrepreneurial,
just getting out there and
hustling.
And if you get fired, you're going to get another job. And if you relocate to another part of the country, that part of the country will rebound even if your home state's not. And so people have not been, savings comes from anxiety and the knowledge that you're going to have to rely on your savings to get yourself through trouble. And if the society is, for good reasons as well as bad, allowing you to get through hard times, either by letting you borrow a lot of money on your credit card or by giving you another opportunity to try again, I don't think that. And I think that's why the Japanese saved more, because they had such a horrific period there during and after the war that it's taken 2 generations to forget that.
So it's an excess of good old American optimism
problem
that got us into the trouble in the first place.
But, if anxiety is the psychological impetus for savings, are then Social Security and Medicare to blame? And if we ask Chinese why they save, they say, well, what happens if when you retire you need to save? So maybe was it a kind of, as we worked our way culturally into these entitlement programs, that now this is the natural outcome of that, and that we can't have a higher savings rate with the entitlement programs?
Well, I think there's a disposition, certainly, that Social Security will be there for people when they retire, and less of a rationale to save. And then, of course, people are sadly disappointed when they realize, when they look at how much Social Security they actually have for retirement and haven't saved at all. I mean, I do think that Americans, sort of along this line, culturally we are a bit of fantasists when it comes to our material resources. We dream big, and we sometimes exaggerate the sense of security that we have when bad things happen. So I think there has been a very great optimistic reliance on, you know, what they call contractual savings, both social savings like Social Security and forms of insurance and annuities and things like that to carry us through. And it's not going to be enough for a lot of people.
What would you recommend then, given what we know today, that real interest rates today are negative, and that inflation may or may not occur? If you had somebody in that middle class or the bottom half of the middle class and they come to you and they say, what should I do? Should you say, you just, you know, spend what you got because who knows what it'll be if you save it? Or do you recommend that they save, knowing that they can't perhaps come up with the most intelligent financial strategy like a, you know, like a Bill could? You know, presumably you're going to be okay, Bill, no matter what happens.
I'm going to go live with my kids, so they can support me. No.
Well, I sometimes make a distinction between the investor class and the lottery class. And the investor class, you guys and maybe other people in the room who are very sophisticated and sensitive to changes in a lot of things that impinge on their wealth. And I actually think they'll be okay and figure out creatively how to deal with you know, rising inflation. So I worry about the 70 million people in America who just aren't saving at all. And so my wish and desire would be to get a good share of those 70 million people to begin to save for a rainy day and to have alternatives to the way that they finance their standard of living now, which is through credit cards, payday loans, pawn shops, and, you know, some of these, you know, anti-thrift institutions. Mm-hmm. That would be my magic wish.
So you got to get them. You got to start that 70 million population saving.
Yeah.
And what about you? Would you have any hesitation or reservation about getting that person to set aside what modest amount they have into something that may not generate a return for them?
No, I'd have no hesitation at all, but not because I necessarily think the money is going to get them through a rainy day, but because the psychology of saving money, which I would guarantee almost everyone in this room has carried with them in their own life, is a great resource for everybody. And if the poor have been led or have led themselves into thinking they don't need to save, accompanying that psychology is a general attitude that somebody else is going to take care of my problems. So the moment you start saving for yourself is, you know, one of the keys to that fantasist sort of sentiment of opportunity is the idea that you have it within yourself to do it. So I think saving has a profound benefit. And if you ask, like for my kids, you know, I tell my kids to save money. In many ways, it's ridiculous. Why should my children put $500 in the bank? You know, I have means and I can pay for their college, and what are they savings for? But I'm teaching my kids, I'm putting my money where my mouth is. I teach my kids to save because I want them to have that strength, like I try to teach other character attributes to them. So why would I want anything different for the lottery class but to teach you to save? On the back end, this is where I think this project is so important. If we were successful, if you were successful, Barbara, and you got 70 million people to start saving, well, then it's incumbent upon the leadership not to cheat those people. Mm-hmm. You know, because then there's a reinforcing aspect. It's a great first 5 years, it's huge success. Savings rates gone up. People are putting their $100 a month into savings. Now what? You know, we really don't want to end 5 years later and turning all 70 million to a new level of cynicism by denying them their money.
That's a really important point, because I think as a result of what we all know has happened in the past few years, there's been a loss of trust in institutions, and in the sense that You know, they're sort of institutions that will be helpful to you, both on the financial side and the governmental side. So there's this profound mistrust, and then I think it does lead to cynicism and kind of I might as well roll the dice, literally or figuratively, and there are a lot of casinos now spreading, so more opportunities to roll the dice, and, you know, just take my chances.
But why would then a policymaker, I mean, it's unattractive, this population of 70 million people that need a leg up, the last thing they need to be is cheated in your term. Why would, and we know, Ben Bernanke is not, he's not a venal man. He doesn't have bad motivations, nor I think do, many of our elected officials at the highest level. So why would they do this or contemplate doing this? Presumably it's within their power, within the power of policy somewhere, either at the Federal Reserve or within Congress or the executive, to not cheat this population of people, or not to create inflation that would gut the American saver, to use the title.
I have to answer this question. I think they don't know what they're doing, and I don't say that because of there's a different set of men and women that could step into their shoes who know what to do. I don't think anyone knows. And if you go back and read those, Weimar Germany, they didn't know what to do. They were genuinely confused. So I was talking earlier in the evening, the central bankers in Germany, when the hyperinflation was going crazy, looked at the data and decided that the acute problem in Germany was that there wasn't enough money. And the printing presses were running around the clock, and they ordered more paper and printed more because their analysis was that the problem in Germany was there was an insufficient amount of money to buy the goods and services that were for sale, and the economy would soon collapse if they didn't print more. And they were, in that micro sense, right. Prices had accelerated so tremendously that there was a shortage of money, and farmers couldn't sell their goods because there wasn't enough money to buy them. So you asked what was going on then, it's the same as going on now. Once these situations get difficult, there isn't any obvious solution. So I don't think Bernanke or these other fellows actually know what to do. So I don't think they're sitting back and saying, let's take a little risk with inflation and maybe the savers. I think each month brings them a new challenge, and they just keep experimenting on the way. So,
would we be in a better situation, let's say, at least talking about the Federal Reserve, if they only had one mandate of price stability? Presumably that would make it easier, maybe not to mess up. And I'm wondering if part of the logic or the rationale that you would have were you them would be this population of 70 million, or the bottom half, or whatever their population target is for their policies, presumably not the ultra affluent. They're in a pickle. Either we're going to have some inflation and they're going to keep their jobs, or we'll have no inflation but they're going to lose their jobs, and there's a trade-off, the Phillips curve, between inflation and unemployment, certainly in the short term, and therefore they have to start making these compromises. Do you think that's a valid way to think about it? Is that the way they think about it?
well, and I think I would go even further and say, sort of, they need to take one of the Hippocratic Oath and say, first do no harm. I would go even further and say, first do nothing. That, in fact, if the government would just stop doing anything, and I'm not trying to be that funny, but I mean it, Calvin Coolidge style or not, but the problem is no one knows, since no one knows what to do, we all know the government is going to continue to experiment, and that's a frightening prospect. So if the government, and therefore let's start with the Fed, if they just decide they're going to do less, and so I'll take your point, if they say we're only going to worry about price stability, then you have a narrower range of activity you have to anticipate the Fed taking, because they're going to work within that band. And if the federal government, the legislature decides all we're going to do is borrow money and stimulate, as horrible as that is, there's this path we're on, and we can all start to work our way around it. And the tension between price stability and a Congress that intends to be deficit spending forever is, we can start to work out what's going to happen now. I think one of the problems is the mandate of the Fed is at this point completely beyond, I don't know what their mandate is. As far as I can tell, they can do anything they want. And they might do something radically new tomorrow. And so I think that's a huge negative contribution to restoring order in a fiscal and monetary realm. So
if you read Paul Krugman,
he's a very confident man.
he's very confident. I mean, he would tell you that this is baseless, worrying about inflation, and that the Fed is doing it should do more of what it's doing in order to have full employment. And I guess the question there is, why do we not? I mean, why are the unemployment numbers so high? And I think what he would say, if I asked him that question, is, well, we aren't doing enough. We should do more of the same.
We need to print more money.
Right.
Yeah, he's just like those fellows in Weimar Germany.
So, so it is a bit of a conundrum for a non-economist type like me to try to figure out what our Federal Reserve is trying to accomplish.
If savings are a good thing, why not mandate it? So we've mandated already, I guess, through Social Security has mandated savings in a certain form. Should we just, if we want a 10% savings rate, just say you're going to save 10% and guarantee the people a real return? Is this something, or is it a virtue that people have to avail themselves of voluntarily, this action?
Yeah, well, I'll just take the weaselly way out and say I think it would be politically the most unpopular idea you could imagine. People don't like the government right now, and they don't like mandates. So as important as savings is, I think people want to feel that this is something they do for their own reasons, for achieving independence, a sense of freedom, for the purposes of thrift. And it would just really kill it, I think, if we had a government savings mandate. There are things that government can do to help, but not that, in my opinion.
So would you undo Social Security then on that basis?
That's, could somebody else answer that question? This is out of my wheelhouse, I think. What? Do you have a view?
What was it? Charles Murray had his book, The Plan or whatever, and you could replace Social Security and Medicare and all that if you just gave everybody $10,000 a year for life. And it's a great book, very interesting concept. So certainly in the laboratory we could come up with ways to replace Social Security with something else, but I think it's a non-starter. So you could anticipate making a change in Social Security that takes effect 25 years from now, and that might be a productive area to have the discussion. But otherwise, it's so built into the fabric of society that I wouldn't do it. But I would say, if you think about mandating savings, I would never recommend. For years, when people have asked me about an IRA or something, I tell them, don't bother. That's not savings. And I would worry that mandated savings would have the characteristic that I loathe in IRAs, which is savings is for me to take care of my family, to meet my emergencies, or to seize my opportunities. And when the government tells me that since I put my money in retirement savings, I can't touch it until some magic age where they think I need it, and otherwise there's penalties and complexity, and I get some nominal benefit of tax-free compounding, it's not savings. Savings is control over your own life. And so I would reject mandated savings because they necessarily would come with all sorts of restrictions. You can't mandate savings and then tell somebody, oh, next year you can spend it if you see a great business you want to start.
And complications, as you said, and I think if we could figure out a simple savings instrument for people we want to encourage to save that doesn't have all these rules, restrictions, and complications, that would be an improvement.
So let's do that just before I open it up to everybody for questions here. So what would you do, given the problems we have, the problems with the low savings rate? What would be your program or policy that would remedy this situation of low savings here in the United States?
Well, I made a little series of notes on this topic. I think, I'm serious, I do think if we had a relatively low risk, easy to understand savings instrument for my 70 million Americans with a decent rate of return, nothing great. Remember money market funds? They were popular with most people, easy to understand. I don't know what happened to them, but So design one of those, easy to understand, low risk.
And what's a reasonable, is 1%, 2%, 3%, what's a reasonable real return to get?
Well, I don't know, but I think 2%, 3% would be okay. But that's for you guys to figure out. And then I do think that if we could eliminate the tax on savings interest up to a certain level to encourage savings, that would be a good idea. Another idea would be to try incentives to foster or bring back some form of community banking. Some of our friends in the credit union community have said deregulate some of the more onerous regulations on credit unions and community banks, particularly those that serve kind of non-saving or under-saving population. That would be a good thing. Thrift education for young people to get at the character, virtue side of things. I like financial literacy, but I think that sometimes financial literacy is about numbers and compound interest and not enough about sort of the value of, the ethical value of wise use of your money. And then did I have a final one? Well, I can't read my writing, so I guess that would be where a few things.
Bill, anything to add or change?
I'd pull out from what Barbara said. The one that strikes me as most important is to allow a substantial annual interest and dividend and capital gains amount to be free of tax. And I picked a number out of air the other day, like $20,000 a year. And the idea is that if you really get going in savings, and I started thinking, talking to a colleague, okay, what's the amount of money a working person, what would you want to have at 62 years old when you looked at a person and the wife was a nurse and the husband was a fireman, and you said, well, they're about to retire, how much do they have in savings? Well, if they had $250,000 in the bank in today's money, you'd say, well, all right, they saved some money, and they presumably have Social Security and maybe a pension, but they have that amount of money. So then you think, well, in various interest rates environments, how much money can you earn on $250,000? Well, maybe you could earn 8%, make $20,000. Well, that means if you started today with your $100 and you save all the way up to your 60s and you had your $250,000, you'd never pay taxes on your earnings on it, except maybe those rare years where you had an internet boom and you owned all that stock and you sold it. But that would be great, because then you could really say to people, you can be confident. And of course, you have to index that $20,000 to inflation so that the government doesn't have a backdoor way of taking you out. But now you have a pool of money, whatever you do with it, money market account or stocks or whatever, and people's sophistication grows when their money grows. So you are very flexible, no controls. You can take your money out, spend it if you want, put it back in, but it's free from that. And I think that's important. But I would also say the one thing you missed on your list, which when I first heard of the work you're doing, I hated it, but I think you need to impose usury laws.
Oh, that was it. Thank you. Thank you, that was
Nixon
it.
going to China and all that stuff is a former, in my sins in my youth, I was a libertarian, and I really thought it was great when they got rid of the usury laws. But in retrospect, it's disastrous. And so if you just put harsh usury laws on credit cards and the like, it has this interesting dynamic, which is it's no longer interesting to me as a credit card provider to mail cards to everybody if I can only make 8% on my portfolio instead of 14%, because I can't have default rates of 5 or 6% anymore. So I now have to be more selective about credit cards. So you didn't say we should shut down Social Security, but I'm braver. I went on record for usury laws. So now bankers all over the world will be looking for me.